Yes, sir, we can start.
Yeah. Respected Chairman, C.H. Chinnamathan sir, in absentia, and the Secretary sir of SIRC, Mr. Kelly sir, in absentia, and the members attending this program of today's program, which is on auditing standards 700, 701, 705, and 706, which is on opinion and reportings, communication, key audit matters, and modification of opinion of independent auditors, and emphasis of matters. Very useful subject for us to present in this year. And this has been the selection of topics, and being a chairman of the audit committee of SIRC, Auditor, auditing standards and accounting standards and ethical standards committee. I think they have put me onto this job of introducing our today's speaker, Sri Bisworajan Sutar sir. Namaskaram sir. I welcome you all to this program, and the supporting staff here. I welcome you all of them. Let me have the pleasant job of introducing the speaker of the day. Is a rank holder in commerce graduation, a fellow member of our Institute of Chartered Accountants of India, and an alumni of IIM Calcutta, currently working in a leading chartered accountant firm. Before joining this, he had worked in the Big Fours, and he has vast experience in auditing of large sector listed companies, PSUs, and banks. Apart from assurance services, being a certified IFRS professional involved in large number of GAAP implementation, valuation, and related consultation of various entities. Further, has delivered number of lectures both in in-house corporate trainings and academic professional institutions like ICAI, ICSI, IIPM, etc. on subjects like valuation, startups, Schedules 3, IND AS, CARO, etc. And most appropriately, is ex-chairman of ICAI Bhubaneshwar, and is a co-opted member of the Committee of Corporate Alliance Law and Corporate Governance of EIRC. I welcome you, sir, and I hope that our members are enjoying this program which is on every day. We are almost on every day. We are giving some live programs, and the purpose of this is our members are enlightened on the subject and enriched on their knowledge. Yeah, I don't want to speak much on this because our speaker is here. Please, your forum is yours, sir. Thank you, sir.
Thank you so much, sir. Respected respected chairman and secretary of SIRC in their absentia, very senior most professional and treasurer of SIRC, C.H. Sundaranjan, the staff members and members actors sitting the board. Thank you so much for inviting for this session, and very good afternoon and good evening to all, because there is a time gap between Southern and Eastern. So I said good afternoon and good evening. I believe at the outset that the topics selected for today's discussion are not new, and there have been a couple of years passed by on which we must have attended the scores of seminars on this, and we have 3-4 years of reporting we have done. But what is special about this year is a lot of changes is happening around reporting framework, be it Schedule 3 requirements, be it CARO requirements, or be it transition of reporting quality deliverables so as to meet bridge the gap between expectation gaps of stakeholders. And the timing of this seminar, I'll say, Sir Sundaresh, is perfect and apt, because for the financial year 21-22, for which we are going to do our reportings, yes, of course, for listed companies we have done with 2 weeks back, we have completed almost all listed companies. But majority of the private companies, the activity of auditing and assurance just about to start or started. And to be very honest, from bottom of my heart, and being in this profession for quite some time now, the reporting aspects and especially drafting of audit reports always takes the last minute job of ours. And to be very honest, I expect from the participants that those who work on a small and medium farms, those who represent small and medium farms, we hardly put our time in drafting the audit reports, wherein the audit reports are the only deliverable or only communication we make at end of our audit engagement to the stakeholders. Normally, what we do is just copy paste of previous year's audit report, change the dates, change the signatures, change the place, and do it. And there is could be a counter, like my article says that these are the seven. If you talk about 700 group, today we'll be discussing 4, but in 700 group there are 6 standards. All are the simplest of standards and small in as far as number of pages goes. But I tell them categorically, the smallest of standards have bigger implications, and these are the only standards which demonstrates our work we do for any client, for any stakeholder. So the criticality of these standards are huge. Specifically today's time, we'll go one by one the standards we'll be dealing with today. On the practical aspects, I put it very frontly and bluntly that we won't be dealing with the theoretical portions of these standards, because I assume all my professional brothers and sisters have already read about it and being in practice. I'll talk about what are those new changes which we should consider or tick ourselves during the course of audit for, especially for financial year 21-22. What are those small changes has happened and which are the implication while we report. And there are a couple of practical aspects which we should look into, because there are n number of reports by quality review boards and respective agencies that where we have gone wrong in reporting as far as compliance of SA 700 and related standards are. So I'll go with my screening of the shares, and I request if anyone has any doubt during our discussion, please pause me and raise their queries. We'll be happy to share those discussing that. Yeah, can anyone confirm me that my screen is shared properly?
Visible, sir. Visible, sir.
Yeah.
Visible, sir.
Thank you, sir. Now, today the agenda is we'll be discussing about 4 standards. SA 700, which talks about forming an opinion and reporting on financial statements framework. There are 2 standards related to this, 705 and 706. 705 talks about modifications to the opinion, and 706 is all about UMs and other matters emphasis. And 701, yes, it is not applicable to private companies. It is all about related to key audit matters. It is not related to private companies. It is related to listed companies. But as far as private companies are concerned, it is optional. It is auditors based. If you want to put KMs in your audit report, you can do so. It is optional. So what we'll do in our discussion is I'll sequence 700, 705, 706, and at the end we'll take up 701. And in between, as I said, we'll be discussing all practical elements of these standards actually happening around, and all those changes which has happened with respect to Schedule 3 and CARO 2020, which got an element of impact in 700 reporting, that I also bring before your discussion. If you talk about, I'll just brief about the basics of 700 structuring, so that I go deeper inside and we discuss around what are the practical issues coming up. So this is basically, if you visualize your audit report, the structure of any audit report in company. These are the structure of audit report, which is compliance of SA 700. First title at the auditor's opinion, then basis of opinion, going concerns, camps, then comes then other information wherever it is applicable, then responsibilities of the management, we explain it out, auditors responsibilities, then other reporting responsibilities under section, there are different sections applicable to it, then signature of the auditors, and we end our auditing report deliverable. So here the most practical thing which I would like to very specifically stress upon is about the signature and generation of UDIN. We must be aware that nowadays affixing of UDIN is mandatory. The common errors we do in putting UDINs in audit report is normally we take the pleasure of putting UDINs as a printed on the auditor's report, and normally in 90% of the cases we generate UDIN on the backdate. Yes, of course, there is a legal boundary or timeline of 60 days are available with us, but for QRB's perspective, and if you look into the UDIN generation guidelines, UDINs has to be manually written in your auditor's report. Now the question comes, what happens if we print the UDINs on the auditor's report? No doubt, the auditor's report, we can print it, but there is a time gap between the date of auditor's report and the date you generate the UDIN for that date mentioned in the auditor's reports. Normally there is a gap. So when I'm generating the UDIN, say for today, of an auditor's report of say previous week, which I can do so, if I mention the time, print the UDIN in the auditor's report for QRB's perspective, it is wrong. Because if you see the time log, it is as if I have not signed the auditor's report that day. So please avoid printing UDINs on your auditor's reports. Make sure that you handwritten it on the auditor's report. Next, going forward, the first, I'll give a, before we sign and issue this auditor's report, what are the things we do it stepwise? And this is broadly, this chart explains out what is the logical sequencing before we conclude our opinion and form our opinion and issue the audit report or audit opinion. The two aspects which are critical is about, if you see the below two standards I have mentioned, SA 450 and SA 330. The compliance of these two standards in terms of checklist compliance, in terms of your work compliance, is critical, because we form our audit opinion only based on our substantiated audit procedures and appropriate audit evidences. So if my audit documentation in this regard is not complete, then I should make sure that it is complete before I draw down my audit report. What happens, as I said at the beginning, we take very least amount of time, give least amount of time when we draft the auditor's report. Many of us want to understand what is the requirement of auditor's report. So we missed out our documentation. What I suggest to you is that you go through SA 700 requirement, prepare a checklist, and take down during the process of audit. These are the requirements which hits directly in your reporting requirements, and you'll find there is a lot of changes and quality brings to your deliverables. Now, in the sequence of auditor's report, the blunder or the mistake in general we do is related to reporting of going concern. And with this, I'll bring to the aspect of what change has been done with CARO 2020 also. Now, many of us feel that if there is a comment on going concern has to be made, it has to be a qualification. For all clarity, comment on going concern is not a qualification or modification to the opinion. It is separate. And reporting under going concern is not done under SA 700. It is done under SA 570. So if you go through SA 570, there are different aspects of going concern being explained out, and it talks about how you modify or comment upon going concern in that particular standard. So normally what we do, we take it as a modification to opinion instead of putting a separate paragraph for going concern issues as far as reporting is concerned. So what changed now? The concern is what change has happened in Caro. If you recollect Caro 2020 order para 3, out of 21 points now we is supposed to report upon, there is a point 19. If I can read it for you, Caro point 19 of para 3 talks about the auditor has to specifically answer whether the company is capable of meeting its liability within falling due within a period of 1 year from the date of signing of report. So if you visualize this statement, and if our answer is no, then somewhere we are talking about the liquidity crunch of the company, and somewhere it is triggering around issue of going concern. Now the question, normal practical question about this, if the answer to this question in Caro is no. Yes? Yeah. If the answer to this question is yes, the company is not capable of meeting its liability when falling due, is it a going concern issue? The answer is no. It is just a trigger point for going concern issue. It is not a going concern issue. Many of us, what we do that understand or assume that if I am reporting under Caro this point, there is no issue of requirement of reporting going concern issue in the face of auditor's report. Normally we do this mistake. Please avoid doing this mistake, because reporting under Caro is not modification to auditor's report. There could be a modification, potential modification in the auditor's report. And as I said, if the company is not capable of meeting its liability when falling due, is not a question mark on the going concern of the company. It is just an element or the trigger point to evaluate whether the going concern issues with the company exist or not. Based on your further audit procedures, you can conclude whether there is a going concern issue or not. If you find out with substantive audit procedures that there is a going concern issue with the company, then please go ahead and report in the going concern paragraph as prescribed under SF 570 in your main auditor's report. Don't end your reporting with Caro itself. So there has to be two separate reporting to this. So this is all about going concern reporting as far as SS 700 is concerned. Now, there are two aspects, bulk of the aspects which take space in our auditor's report. One is responsibilities of the management and responsibility of the auditor. Now, if you talk about responsibilities of the management, nowadays in SS 700, we clearly explain out, look, these are the responsibilities of the management with regard to financial statements. And broadly, this covers up all the responsibilities taken care of by management. But more broader aspect is about the auditor's responsibilities. If I take you slowly that what are the elements which auditor specifies, like me before signing the report or at the time of signing the report, I'm specifying that these are the things I have done. Now, if you visualize these things, I'm putting it in writing that these are the things I've done and compare it with your work papers, you'll find suddenly there is a quite gap. And see those powerful words we are using in auditor's responsibilities. First, reasonable assurance. I are giving reasonable assurances. Am I confident enough or fully confident enough that my work papers are sufficient to corroborate this fact that I'm able to give a reasonable assurance about the financial statements. Material misstatement. Now, I'll take some time on this material misstatement. In auditor's report or any documentation, lot of time you'll find this phrase material. And I'm again confident that many of us, for any audit engagement, we don't define or calculate the materiality level of that particular engagement independently. Please mark my words, going ahead, please make use of SA 320, which talks about how you calculate the materiality level for any audit engagement, and please make that materiality calculation done for each and every client of yours, for each and every audit engagement of yours, and make sure that it forms part of your audit documentation. Because tomorrow, if something goes here and there, this is the one of the key documents which is going to come handy before you when you defend or say, look, I've discharged my duty thoroughly and properly, just and fair. So materiality makes a sense, and computation of materiality and complying of SA 320 for any audit engagement makes sense. Next, we are saying in our auditor's report that I have complied with all standards on auditing. When I say I have complied with all standards on auditing, that means my documentation should be complete with all standards on auditing checklist, that whatever standard on auditing specifies, whatever applicable to that particular engagement, I have complied with, and those compliance has to be demonstrated through a proper documentation process. Again, misstatements can arise fraud considered material. So I have taken cognizance of all material aspects in my audit. Then it talks about professional judgment. I have exercised my professional judgment. So what about exercising your professional judgment? Look, when you are going to audit, we based on our requirement checklist or a requirement client checklist, we got certain informations. Before forming an opinion, I should apply my wisdom, and I will apply my professional skepticism and judgment before concluding that whatever financial statement numbers are coming, it is true and fair, and it is extending proper reasonable assurance. So that assessment of reasonable assurance can only be done through professional judgment and professional skepticism. So this has to be assessed in corroborative with whatever information and documentation you have gathered through during the audit. Then it talks about I have communicated with those charged with governance. So in many of the audits, my only delivery to the only communication with the client is the auditor's report. Normally, we don't issue MRL, we don't issue observations to the client, and we don't do any sort of things. So please make sure that before, from the starting of the audit till conclusion, there are enough number of communications with those charged with governance, specifically with related to your planning, scope, timing, and significant audit findings. Because suppose tomorrow you are bound to find that in a situation that modified opinions required for that particular audit engagement. But before issuing the modified audit opinion, you're supposed to communicate with the key management people or senior management people, but you have not done that. Then it is an embarrassing situation, and for the auditor also to issue that modified opinion. So make sure that during the process of audit, you communicate with the management, especially those who are charged with governance, all your planning, scopes, timings of audit, and specifically significant audit findings. Then the auditor specifically, explicitly talks about that he has complied with all ethical requirements regarding independence. So here, normally what we normally don't do is we don't take independence declarations from our audit staffs and articles. So for every engagement, make sure that your audit independence declaration is being obtained from your staff members, those who are engaged with that particular engagement. Then CAM, we'll talk about this CAM matter separately. Then in our auditor's responsibilities, staying in SS700, we discuss about specific key aspects of audit, like internal control, relevant audit in the order to design appropriate audit procedures. Then we talk about, is my screen is shared? Yes. Then evaluate appropriateness of accounting policies, that evaluations we need to do. Then going concern we need to evaluate, and we explicitly say that these things I have taken care of. And most importantly, the presentation framework. If it is India's compliant company or normal accounting standard compliant company, all those things are taken care of. So these are the responsibilities of the auditor, which we specifically write and communicate to the stakeholders in our auditor's report. Now think about a situation where you are writing all these things specifically in your audit reports, and think about the audit documentation you have for that particular client, and assess yourself. Now visualize what kind of gap right now exists between the work we actually done and what we are reporting. So there is a quite huge gap, and today there is huge kind of risk we are putting on ourselves by widening this gap. So please make sure that your audit documentation is proper and appropriate, which is requirement of the auditing standards and specifically SS700. So make sure that your checklist are properly designed and filled in before you conclude and issue this communication to the stakeholders. Now, in the auditor's report, there is another segment where other reporting responsibilities we should report. I'll talk about, because there is a change with this starting from this year. 143.3, it is applicable to all. Then CARO 2020 is now there, so that will be reporting. Then banking regulations, wherever we are reporting for a banking company, will comply with that. So these are the other reporting responsibilities wherein you report. Now, this year, other matters where companies audit and auditors rules 2014 got amended. There are six items got included, out of which one got deleted related to the which came in the year demonetization happens. That is no more, it is there, it is removed. There are three items new there this time, which mandatorily is going to be reported. And I'll suggest that there is an implementation guide which has been issued by our institute. Please go through that guide. I've given the link of that guide in this presentation. Please go through that. But out of these three new items, two items are applicable for this year, and the third item, there is a deferral of implementation that will come for the financial year 22-23. But staying within 21-22, these two items, please make sure that you got sufficient kind of audit work and representation. The first 11E, it talks about transactions related to ultimate beneficiaries through intermediaries, transfer of money or receiving of money. So if you see, visualize CARO 2020 also, there is a same reporting requirement is there in CARO 2020. But in SS700 also, since there is an amendment to this company's audit and auditors rules 2014 with effect from 1st April 2021, this reporting has to be done. So there are three, under section E, there are three subpoints, and first two subpoints talks about giving of fund and receiving of fund for ultimate beneficiaries. Third, about our conclusion based on our audit procedures. If you read those first two paragraphs, 1 and 2 subparagraphs, it starts with whether the management has represented that. So to our understanding and our work extent, there is a limitation. We can rely on the management representation. But on the third point, This representations has to be corroborated with our audit procedures. We need to take care of further audit procedures to ensure that these transactions are not there with the company. So please go through that implementation guide, which is available, which got recently issued by the issue, which is available, because this is the new reporting we'll be doing for all our clients. This is all related to receiving and giving of fund through intermediaries to ultimate beneficiaries. Then the second, which is applicable for financial year 21-22, is the compliance of section 123 with related to declaration of dividend. Again, in the implementation guide, they have talked about different instances wherein the company has declared interim dividend or final dividend, and appropriate level of compliances of section 123 is required. So you need to specify those instances and what compliance the company has done, you have to specify. The last point related to accounting software and audit trail. This reporting point has been deferred because initially when it got issued, it was applicable for the last year, financial year 21-22, but due to this deferral, it will be applicable for financial year 22-23. So we'll be doing a reporting under this clause when next year will come for financial year 22-23 audit. So for 21-22, our reporting under other matters as far as companies audit and auditors rule is concerned, will restrict ourselves till point number F. A, B, C, D is omitted, E and F. So these are the few new elements that we need to take cognizance of when we are going to issue report for the year 21-22. Now, so this is more of overall picture of SA700. Now, staying with SA700, because unless we talk about modifications to opinion SA705, our audit reporting is not complete. Now, modifications to the opinion, normally we are of the view, or in our mind, it is always there when you talk about modifications to the opinion, it is the qualification. For all clarity, for the purpose of all clarity, let me tell you that qualification is just an element to modifications to the opinion. Modifications to the opinion got 3 elements, out of which qualification is just 1 element. To give more clarity, in modified opinion, there are 3 versions of modifications. One is qualified opinion, second is adverse opinion, third is disclaimer. We'll discuss one by one what is qualified opinion, adverse and disclaimer. Before we say that this particular transaction or this particular instance requires a qualified opinion or adverse remark or disclaimer, there are certain factors which we need to consider. There are 2 elements which gives a trigger point for issuing modified opinion. First is nature of the matter giving rise to modification. What could be the nature of matter which gives rise to the modification? In any audit, there could be 2 instances. One is it is related to FS item, line items which are materially misstated, like any transaction which got materially misstated, or any GL balance which got materially misstated. That is on the FS line items. Second is during the process of audit, the auditor has not obtained sufficient and appropriate audit evidences to that particular item, so before it concludes its audit opinion. So first, the nature of matter which gives rise to the modification is on account of 2 things. First is there is a material misstatement in the FS level itself. Second is it is the inability to obtain sufficient audit and appropriate evidence leading to possible mental state misstatement and financial statement. Then second aspect which factors in before issuing the modified opinion is our judgment. As I said, professional judgment we need to put in before we draw any conclusion for any engagement. So auditor's judgment with respect to pervasiveness of effects and possible effects of material misstatement in the financial statement. We will discuss about pervasiveness in little detail. So normally, there are a lot of confusion goes in whether I should qualify this, whether I should put a disclaimer, whether I should put an adverse opinion. Please make sure that this table forms part of your checklist, which gives an indication that depending on what situation, what is required and how you modify your audit opinion. This simple table explains all possible scenarios wherein you need to conclude your modification. As I said, there are two matters which gives rise to the modification. First is your financial statement are materially misstated, and second is inability to obtain sufficient and appropriate audit evidences. Now, the first is how I'll judge if the misstatement is material but not pervasive. Mark my words, if the material misstatement is material but not pervasive, if the matter is at FS level only, then you issue a qualified opinion. If the matter is at inability to obtain SAE, then you also issue a qualified opinion. But the moment the material misstatement is material and pervasive, then if the matter is at FS level, it is adverse opinion. If it is combination of FS level and inability to obtain SAE, sufficient and appropriate audit evidences, you issue a disclaimer of opinion. So under one situation, you only issue adverse opinion. Second is disclaimer opinion. But if it is material not pervasive, in both the cases, you issue qualified opinion. We'll discuss about what is pervasive so that we can be clear of this table. Now, pervasive. This pervasiveness is related to misstatements and its possible effect and impact on the financial statement. And when we talk about pervasive, it is normally it is not undetected due to inability of obtaining sufficient audit and appropriate evidences. So if there is a misstatement and we are not able to quantify it, we are not able to assess that this misstatement is leading to this kind of impact, then it is pervasive. So in case it is pervasive, you would need to think of whether you issue a adverse or disclaimer of opinion. Now, what are the circumstances when modifications are required? This understanding is more critical because normally we end up not issuing a modified opinion because we don't understand the circumstances where it is required, and many of the cases small practices, what they do, since they have given a positive and negative reply to the CARO, they think that I have qualified in the CARO and there is no requirement of issuing a modified opinion in the SA 700 main primary report for the purpose of clarity. Our answering to CARO, because if you see specifically to CARO 2020 ordering and the manner in which the questions are asked, it is pure binary. Either you need to reply yes or no. And those replies, if in some cases we are replying no, and in some cases we are quantifying certain things, that does not mean qualification. Again, for the purpose of clarity, any remark in CARO is not modified opinion or any opinion. CARO is just as an auditor, I should answer to few set of questions. That's it. My modification qualification has to happen in the main report, and I should not at any point of time restrict myself that yes, since I have addressed that particular issue in the CARO, I should not be required to put that thing in my main auditor's report. That ambiguity should go off. My main report is independent of what I have done in CARO. So these are the broad two elements wherein there are circumstances which trigger modifications required in your deliverable or not. And one is related to where auditor obtains audit evidence, and second scenario is where auditor is not able to obtain audit evidence which is sufficient and appropriate to conclude its opinion. When suppose in first scenario where auditor obtains audit evidence, there could be three situations where there could be a question mark on appropriateness of selected accounting policies. There could be application of selected accounting policies. There could be a question mark, and there could be a question mark on appropriateness of adequacy of disclosures in financial statement. So these are the things where you need to trigger modifications of opinion in your auditor's report. For example, suppose today you are going to implement a revised Schedule 3 and you're supposed to draft the client supposed to draft the financial statement as far as the revised Schedule 3 requirements are concerned. So you find certain items in accounting policies are missing. You find certain disclosures which supposed to have been disclosed as far as revised Schedule 3 is concerned, but the management is not willing to disclose those things. So these are the elements or situations where you got audit evidence of not disclosure and you feel these are material enough to be stated in an auditor's report. Then you go ahead and modify your opinion. Depending on what category it falls in, you modify either as a qualification or adverse or disclaim. Now, in second situation where auditor is not able to obtain sufficient and appropriate audit evidences, there could be few things. Limitations imposed by the management or circumstances related to nature or timing of the auditor's work. Normally it happens in bank audits that your time is very squeezed and all those things. Then circumstances beyond audit entities control. This situation has happened with us last 2 years because of COVID. Because of COVID, there are limitations in audit and discharge of audit functions. So appropriate disclosures are gone ahead. So these are three broad elements wherein your SAE is not complied with and triggers modifications appropriately in your audit report. Now, the scope limitations, which I would like to more emphasize upon a little bit before touching rest of the matters. In scope limitation, there are many situations where as an auditor, we find there is a limitation of scope once we accept the engagement. And again, for the purpose of clarity, scope limitation always goes for modification in opinion in the form of either adverse or disclaim. A scope limitation audit cannot be a qualified opinion. A scope limitation audit has to be an adverse or disclaimer of opinion as part of your modified opinion. Now, but there are certain things as an auditor we should do. Normally, we don't do or ignore about it. So I thought I should specifically talk about this point related to scope limitations. And if you follow this chart, I have specifically stated what we should do at each point of time. First, normally scope limitation in majority of the cases comes before us post acceptance of the engagement. Once we land up at the client place, the management states, look, these are the limitations are there related to when you start asking for the documents. If that is the case, then immediately, either depending on the gravity of the situation, either we resign or go ahead with the audit, and request the management to remove the limitations. The first kind of communication we should do with TCWG for the removal of the limitations. If the management says there cannot be a situation where these limitations can be removed, there could be many instances. Like, for example, as part of audit procedures, we are supposed to look into the board meeting minutes. If the management says those board meeting minutes cannot be made available to you, it's a scope limitation. Now, Schedule 3 talks about aging of your CWIP. It talks about your cost overrun, time overrun. So if the management says you cannot be given access to the capital budget of the company, you cannot be given access to those board plans related to major capex situations, then it is a scope limitations. So post communicating the scope limitations and requesting the management that you please remove these limitations, if management says that there are limitations which are going to be there during the course of audit, now it is up to the auditor to assess whether these limitations, what kind of degree it's going to impact its work. If you feel as an auditor, no, it is going to impact and the degree is substantial, then you immediately resign and stop going the work. So it's a resignation, straightforward. But if you feel no, there could be a limitation, but I'll go ahead with the work, then you find out the possible effects of pervasiveness. Now the pervasiveness comes into your table. Suppose, for example, they have not shared with your board minutes, then how you know the investments or transactions with your related parties? If your financial statement talks about huge transactions with related parties, but you have no access to board minutes, all those approvals, then it's a question of this item might impact all other GL items. So there is a restriction again on your limitations, and it is pervasive. If this is pervasive, again, second trigger is either you resign and communicate with the TCWG. So if this situation, scope limitation, as I said, the audit opinion or modified opinion under scope limitation only can be disclaimer of opinion or adverse opinion. It cannot be a qualified opinion. So at any point of engagement, please test check. Please test check. Is there any scope limitations as far as obtaining sufficient and appropriate audit evidences as per your audit plan and scope of the engagement? If you feel there is a scope limitations, immediately put a mail or communication to the management stating these are the limitations and seek a response. Upon seeking the response, obtaining the response, please evaluate its possible effects. And if you find that possible effects are pervasive, then please modify your opinion and disclaim the audit report. So this is all about scope limitation after accepting the engagement. Now, many times there are confusions or there are queries I find from my team and fellow members also, that what could be the tone of my modification if I suppose choose to modify any opinion or choose to modify my audit report. What should be the tone or the language? There are myths or there are assumptions that if you qualify, that qualification has to be quantified. If I cannot quantify, then it is not qualification. It is not like that. The auditing standard specifically talks about different situations and talks about if you are modifying under those situations, what should be the things or contents in that sentence or paragraph of modifications. So there are 5 instances which the standard itself describes. The first is specific amounts in FS, including quantitative disclosures. If this is the material misstatement, then your modified opinion should have the description, quantification of financial effects of misstatement, unless impracticable. And it's impractical to state, so that also you need to put it. For example, suppose you are auditing a sizable company where PPE forms part of a substantial portion of your FS line item, and there is an issue with depreciation run. Somehow you got gathered audit information and it substantiates that the depreciation quantification is not appropriate. So this triggers a modified opinion. Suppose it breaches your materiality rule, you are modifying. Now you are not able to, keeping the size of the PPE, number of line items, you are not able to compute what is the misstatement in depreciation, and it is not practicable for you. So in that case, it is not appropriate to quantify, because if you quantify, it will go wrong. So in that case, you explicitly spell out that this is the impracticable situation and these are the items. So it is not always that your qualification has to be quantified. It is not necessary. Wherever quantification is possible, you please quantify. But if the quantification you are not able to do it, then you should explain why you are not able to do it, and you should explain that impracticability of that element. If material misstatement is related to narrative disclosures, then you should explain through your modified opinion how disclosures are misstated. So you need to explain a little bit about your modified opinion. Third is non-disclosure of information required to be disclosed. Like there are certain items which got disclosed, but it was not required. It was not required in FS items. I'll give you, tell you a few examples, live examples recently with related to listed companies. In listed companies, especially in LR reports and main reports, now in Schedule 3, ratios analysis are mandatory. But prior to revised Schedule 3, the ratios are not supposed to be given in the financial statement, except in listed companies. That too, wherever listed companies are subject to compliance of Regulation 52. So if suppose a company is supposed to compliance of Regulation 52, there are number of ratios to be given. But invariably, companies used to give their ratios in the financial statement, and they made the auditors form part, because I am forming an opinion on the financial statement, and they intentionally make those ratios a part of the financial statements. Then as an auditor, what should I do? I should communicate with those who are charged with governance and describe the nature of omitted information and spell it out. Again, the materiality and substance over form, you need to evaluate and put your professional judgment whether you want to modify your opinion with respect to non-disclosure of information required to be disclosed. Then fourth is modification results from inability to obtain sufficient appropriate audit evidences. Then into say the reasons of inability. Again, mind you, when you don't obtain SAE and it is pervasive, only disclaimer of opinion or adverse you need to mention, and in that you put your inability of not getting sufficient and appropriate audit evidences. Then last, adverse and disclaimer of opinion. Then you should mention reasons for any other matters which auditor is aware that it would be required modified opinion and effects. Under this, I would like to put emphasis. I have seen a couple of reports where the auditor has modified the report and has modified the report in 3 categories. It has issued qualified opinions, it has issued adverse opinions, and it has also issued disclaimer of opinion. If you see SS 700 and specifically paragraph 15, it talks about avoidance of contradiction. The moment you say I'm disclaiming the financial statement, then there is no question of putting some qualifying opinions on particular elements of that financial statement, because on an overall basis you are disclaiming that financial statements itself. So there is no question of qualifying it. So if someone has qualified or thinking of that I'll disclaim and same time qualify, it cannot be that situation. Either you qualify or disclaim, considering the situation, considering the pervasiveness, considering your audit evidences in conjunction with your professional judgment. So in a situation when you are issuing adverse or disclaimer opinion, then we should avoid issuing qualified opinion for specific elements of FSI line items. So it cannot be both. Now, so this is all about your modified opinion. And the third 706 talks about emphasis of matter and other matters. There are many situations wherein I found, and the QRB also has pointed it out, that people have confused themselves or used of qualified opinion are part of emphasis of matter. For the purpose of clarity again, your emphasis of matter and other matter is not modified opinion. If someone thinks, if I have given something in EOM, I have discharged my duty, no. If that matter has to be modified, that has to be modified. It cannot be unmodified in the shelter of emphasis of matter. We'll discuss one by one. Then what is the requirement of issuing EOMs and other matters when there is a modified opinion standard? There are many instances. You will find yourself in a situation that there are disclosures or there are substantial transactions in FS which requires the users or the audit report stakeholders attention, and as an auditor you would like to draw their attention to those elements in the financial statements. So if an auditor feels that he or she would like to draw the attention of the user of the financial statement through its auditor report on certain few important and fundamental aspects of the financial statement, then it is the medium of issuing EOMs and OMs. For the purpose of clarity, emphasis of matter is not a modified opinion. Emphasis of matter is just we are stressing upon on the fact that the user should read carefully before evaluating the entire financial statement. We are drawing attention of the user to a particular line of items, be it in terms of disclosure or be it in terms of accounting transaction in FS items. There are two situations in the financial statement which requires issue of EOM or OM. EOM is issued in the matters presented or disclosed in FS that are such importance that they are fundamental to the user's understanding, overall understanding of the FS. And OMs we are issuing in respect to matters other than those presented in financial statement that are relevant to users' understanding of the audit, auditor's responsibilities, and auditor's report. So for clarification and better clarity, EOM is being issued by the auditors for FS line items. OM is being issued by the auditors for drawing better clarity on the, or better understanding of the audit, auditor's responsibility, and the auditor's report. Now, how we draw emphasis of matters in para in auditor's report. First, matters should be fundamental to the understanding of SS. If auditors should have obtained SIE and the matter is not materially misstated in FS, it should be fundamental. As I said at the beginning, emphasis of matter are not a replacement of modified opinions. It is standalone. In case I am putting something under EOM para, I am not specifically writing, it is not a qualification, or I'm not qualifying the auditor's report. Again, if I'm putting something in EOM, that should not be repeated in my CAM, key auditors matter. We'll come back what is CAM reporting, but EOM is again not a replacement of CAM requirement. Nor in many of the cases we have seen where auditors have given CAMs under EOM para, which is technically wrong. Now, EOM, if you read out SA 706, it specifically spells out EOM not a substitute for modified opinion. We have already discussed. It is not a substitute for disclosures to be made by the management in FS as required by applicable FRF. This is interesting. In many of the cases where QRB has found that in the financial statement, the management has not disclosed. The management in turn requested the auditor to disclose it in their emphasis of matter. Please understand our auditor report is only based on the financial statement. We cannot talk about the management in our auditor's report. Only we should talk about the financial statement, affairs of the company, and our observations or our conclusions about the affairs of the company through our auditor's report. We should not talk about on behalf of the management. So this standard also specifically debars the auditors that UOM cannot be a substitute for disclosures to be made by the management in FS as required by the applicable FRF. Then UOM not a substitute for reporting on material uncertainty relating to going concerns. There are many audit reports QRB has found out that going concern issues are being reported under EOM para. Again, for purpose of clarity, if there is an issue, if you find that for this particular engagement, going concern is an issue and it requires a disclosure in your auditor's report, then please report it, the going concern issue, under a separate paragraph as guided under SA 570. Don't include it in any part of the UOM or modified opinion or CARO respective point of 19. Please don't include going concern issues, reportable issues under any of the headings. Please put it separately in your auditor's report after basis of opinion as stated, explained specifically under SA 570. Then, when the auditor includes EOM para in auditor's report, what are the specific things we should do as an auditor? We should include para within a separate section in the auditor's report with the appropriate heading that includes the term emphasis of matters. Include in the para a clear reference, because I'm referring to the financial statement. So I should draw a clear reference to the financial statement for which I am giving an emphasis and to where relevant disclosures that fully describe the matter. And normally here I'll take a pause. Normally what auditors have done that they copy pasted the disclosures in financial statement in that UOM. It is not a requirement of reporting standard that you copy paste whatever disclosed in your financial statement as it is in your financial statement. It is not the requirement of the standard. If you want to draw and emphasize on a particular element of that financial statement, please draw attention by giving adequate references. Don't copy paste the entire disclosure in your auditor's report. Then specifically clearly at the end mention, because in auditor's report there could be n number of UMs. There are 5, 6, 7 UMs. Once you put all the UMs at the end, specifically the auditor has to mention that auditor's opinion is not modified in respect to the matters emphasized herewith. As I said at the beginning, emphasis of matter are not substitute of modified opinions. So there has to be specific declaration by the auditor in case the auditor chooses to issue UMs in particular engagement at the end of all the UMs listed out, that these are the opinions is not modified in respect of matters emphasized. If you are not putting this line, auditor's opinion is not modified in respect of matters emphasized, then that could be a wrong signal given to the user of the financial statement and auditor's report that these are the actual qualification, and technically we have gone wrong because we have not worded or tuned those numbers or paragraphs as qualified or modified opinion. Then OM para in auditor's report. What are the things we should include in other matters para in auditor's report? As I said, other matters is related to understanding, better understanding of the auditor's report, audit work and audit responsibilities. You can include it if there is no provision by law or regulation. If there is a provision by law and regulation, you should not include it. Then OM para should not be determined as CAM. Again, there are many instances where QRB has found out that auditors have reported CAMs under OM, other matters para. Please, CAMs are separate, other matters are separate. And include other matters para with a separate heading, other matter or other appropriate heading in the auditor's report. So this is all about your EOM and OM. Any questions thus far?
Sir, we have 2 questions. I'll just share my screen.
Yes.
One.
I'll take it. Any questions thus far?
Yes, 1 minute, 1 minute. I'm just sharing my screen.
Yeah.
Okay, so yeah, is my screen visible?
Yeah. The first question is to conduct audit FY 21-22. We have to keep in mind guidance note of CARO 2020, guidance note on Schedule 3 and implementation guide on Rule 11. If there is an overlap any disclosure procedure, then which one will prevail? See, these three are independent. These three are independent, but I'll draw a conclusion to this. As far as auditor's report is concerned, we should be abide by SA requirement and CARO requirement. As far as Schedule 3 is concerned, it is of the management. So if we segregate these three, like accounting standards are on the management, following of auditing standards are on the auditors. So same logic and regulations, CARO 2020 and Rule 11 is for the auditors to look in. Guidance note on Schedule 3 is the management to look in. Yes, for proper disclosure, we should refer to Schedule 3 requirement. But as far as reporting is concerned, CARO 2020 and Rule 3, we should. I'll bring one practical example which we encountered for listed companies audit. For Schedule 3 requirement, if you see, there are aging of trade payables are required. And if you see the Schedule 3 guidance note, which is now in circulation of the institute, it talks about MSME classification. But if you talk about the law, there is nothing called MSME now. It is SME. So your Schedule 3 is sacrosanct because the format is sacrosanct because it is part of law. I cannot tinker with the format, and the format talks about MSME, but the law talks about SME. So as an auditor, when I'm reporting, what should I do? So normally good listed companies, what they have done, they have written a note below the trade payables that it includes SME creditors. So those kind of things you need to take care of. But as far as auditors are concerned, when I'm concluding my opinion on a particular audit engagement and I'm issuing my auditor's report, for me, sacrosanct is CARO and implementation guide Rule 11. That will supersede Schedule 3 requirements. There are small issues related to guidance note and Schedule 3 and CARO. For example, in CARO 2020, CARO 2020, again a classic issue. In CARO 2020, it talks about standalone financial statement. It talks about consolidated financial statement comment. If you see the CARO requirements, one of the points talk about consolidated financial statement. Now, suppose you are in a group company where SFS and CFS reporting you are doing, and in CFS, there is no requirement of reporting of consolidated financial statement. So in CARO, there are many companies, those who have referred that point that this reporting is being done in CFS, not in SFS. There are companies, those who have reported in SFS also. So little clarity is required, but these gaps are there, minor gaps. But as far as the auditor's point of view is concerned, I should stick with CARO 2020 and Rule 11 requirement over and above the Schedule 3 requirement as far as my audit report is concerned. But financial statement, CARO Schedule 3. Second question is whether uncertainty in going concern assumption can be stated under emphasis of matter or qualified opinion to be issued. No. In no situation Going concern assumption can be clubbed with emphasis of matter or qualified opinion in no situations. Now in CARO 2020, there is a specific reporting under point 19, wherein the auditor has to say or comment upon the capability of the company to meet its liability when falls due. There is a comment the auditor has to make. There are few discussions going around. Sir, if I am reporting that the company is not capable of meeting its liability when falls due, then there is a liquidity crunch, there is a trigger point for going concern. Is it sufficient? I should not, is it sufficient, or whether I need to report going concern in my main auditor's report? See, CARO reporting is an element of your auditor's report. CARO reporting is nothing to do with your modified opinions. Your modified opinions are separate from the CARO reporting. In CARO, it is as simple as that. Please understand, it is a set of questions. I'm supposed to answer those or respond to those set of questions. And those questions, if you see the formatting today, it is purely binary. It is yes or no. If yes, you report to this. If no, you report to that. And that has nothing to do with modified opinions. And specifically, I'm drawing attention to that point number 19 of CARO, the new CARO. This point number 19 talks about liquidity crunch of the company and inability of meeting the liabilities. This situation does not cover up your going concern assumption. It's just a trigger point. If your trigger point corroborated with your audit procedures says that you should comment upon going concern, then you should comment upon going concern separately in your auditor's report, and that reporting has to be done under SA 570 requirements. There is a specific standard for this. There is a specific formatting guideline formatting given under SA 570. Please follow that and report your going concern assumptions under that if you feel it is appropriate to be given. Never ever club your going concern assumption under UM or qualified opinion. There are many cases where I found disciplinary cases have been initiated wherever going concern assumptions has been clubbed under emphasis of matter and qualified of opinion. I'll give you one classic case which has happened this year. FY 21-22 reporting. It is about a listed company. There are reports available now. Since it is public, I can put that. For discussion. With respect to Reliance Finance, you please see the audit report given by the auditor, wherein she has clubbed going concern assumption under emphasis of matter, UM, and see the kind of discussion, the kind of triggers it has already happened, the kind of actions are being getting taken on this. So please avoid clubbing your going concern reporting as part of your UM or qualified opinion. Don't club it. If going concern reporting has to be done, please do it separately in compliance with SA 570 clear. Now I'll take it third point also. If there is a limitation in scope wherein sufficient appropriate audit evidence cannot be obtained in a CAG appointment case, the limitation is mainly on account of lack of finance person at the entity who is capable of sharing meaningful information. What is the remedy as per auditing standards? See, as I said, if there is a limitation to the scope, and it is quite obvious in case of CAG appointments where especially when the auditee is a state government corporation or PSU, it is bound to happen. In that case, these limitations are not on the face of paper. It is a situation, because they say they won't give you in writing that they cannot provide this information. At best, they say they don't have sufficient finance personnel to provide these informations. In that case, first trigger point is that if you find out this situation, there is a limitation of the scope, please communicate this to the management of the PSU and CAG, because your appointing authority is CAG. Appointing authority is CAG. Please communicate both that there is a limitation in my scope with regard to obtaining appropriate audit evidence, and that communication has to be backed by few documents. One is you should have communicated the management your timing and scope of audit as part of your engagement letter, and make sure that the management has signed that engagement letter. Post signing of engagement letter, if the management is not providing you the information, then that engagement letter forms a solid evidence that you demonstrate, look, the management has agreed upon, and now they are saying there is no personnel to provide those informations. So on that basis, please communicate to the management and to the CAG that there is a limitation. There could be situation, I have encountered similar situations. There could be similar situations where CAG extends the timeline of the audit. If that fulfills your purpose, then go ahead with that. If it is not, then depending on the response you get it from the management, think of resigning or think of continuing the audit with a modified opinion. And in majority of the cases, it is advisable either to issue an adverse or disclaimer of opinion as far as your audit report is concerned, because in these situations, a qualified opinion won't hold good. So in particular of CAG audits, the practical approach should be, in case you are not able to get appropriate audit evidences and there is limitation of scope, please communicate with the management and CAG in time, based on your engagement letter executed and based on your requirement list communication with the client and their response there too. Please communicate. Yes, we'll
Yes,
go
sir,
to 701.
Yes, sir.
Hello?
Those are the questions, sir. I'll just share you the presenter right so you can start, sir. 1 minute.
Okay.
So you can start sharing your
Yeah.
screen, sir.
Yes, is my screen
Visible,
visible now?
Visible,
Yes.
sir, please.
Yes, I'll we'll talk about CAM. That is 701. See, at the outset, when I said about given the structure of the today's discussion, 700, 701, 705, 706, always read 705 in conjunction with 705. Always read 700 in conjunction with 705 and 706, because these three in totality is one bucket. 701 forms also part of that bucket with a rider. And what is that rider? CAM, as of now, it is mandatory to be reported for listed entities. It is not mandatory to be reported for any other entities, private entities. But it is optional. But the practical question is, suppose the group company, in a group company structure, if the holding company is listed, but there are subsidiaries, associates which are not listed, private entities, am I supposed to give CAM? It is again what kind of understanding you have with the management and the group auditors requirements. So CAM is optional for private companies or unlisted companies. For listed companies, it is mandatory. But it is better, if you ask me as a professional, what is the best way or appropriate way of giving CAM, whether we should give CAM in private companies or not. Issuing CAM is good, but again there are conditions attached to it. We'll explain why. Let's understand what is CAM. CAM is key audit matters. And what is key audit matters? Which any element in the financial statement which is material and substantial in terms of its impact, significance in understanding a particular transaction. And if as an auditor, I need to do a focused audit in that, then reporting of CAM is mandatory in case of listed companies. So it is all about matters which are most significant. For example, I'm doing audit of a listed mining company. So in case of a mining company, inventory forms part of a most significant element in that company. Suppose I'm doing audit of a very hardwood manufacturing company. Then plant and machineries, PP, forms part of most significant accounting balance in that particular FS line of item. If I'm doing audit of any company where the revenue recognition is complex and huge, so I'm doing a retail sector company where cut-ups are critical, revenue recognitions are critical, then revenue recognition forms part of a most significant item which influences the entire financial statement. So if you find out these are the items which has a significance on the entire financial statement, and these items are assessed with your risk assessment as far as SA 315 is concerned, and you find that this requires a specific communication with those who charged with governance, then putting this element in CAM, it makes sense. Now, whether you want to put it in a private company or not, I leave it up to you. As far as listed companies are concerned, it is yes. For private companies, it is optional. If you ask me, for larger private companies, it is better to put it. I'll put it why we should put it, and I'll say why we should not. What are the precautions we should take care of it. If you visualize the CAM reporting, again, the wrong practice as an auditor we are doing, especially small and medium practitioners. When this CAM came into picture, lot of us, what we did, we referred to bigger companies' auditors report and comparable companies, and we found out there are say 6-7 CAMs are given in the auditors report. We copy pasted those CAMs in our financial audit engagement, as it is, without understanding that it is may not be necessary. These items all are significant to this company, though we have borrowed those CAMs from a comparable company, which is a listed company. It may not be the same case. CAM has to be independently assessed depending on the size of the company, matters involved, and its significance. For X company, the inventory could be a CAM item. For Y company, inventory may not be a CAM item, though they are both same comparable company. It depends on the auditor's judgment and significance of that item in that particular company. Now, if you visualize the structured reporting of CAM, structural reporting of CAM, we should report in two columnar statement. First column, we explain the CAM. Second column, we explain in the auditor's report what is the auditor's response through which we have ensured that we have gathered appropriate audit evidences. We have done all audit, performed all audit procedures so as to give a regional assurance and unmodified opinion on the basis of identified CAM. Now, what is the risk of disclosing so many CAMs? I'm not saying disclosing of so many CAMs bad or good. I'm saying what is the risk of disclosing so many CAMs? The moment you put a CAM, you are owning an extra bit of risk in terms of audit compliance. That does not mean if I don't put any CAM, I'm not doing audit. I supposed to do audit. I supposed to do audit in compliance of all applicable auditing standards. I should do sufficient paper documentations. All it is fine. But the moment I put something in CAM, I should do something extra over and above the normal. Because when a peer review comes, or QRB or FRB, in irrespective of the cases, when they go through the file, they say, if you have identified that this is a significant audit event or transactions, and you yourself identified it is as CAM, and yourself have listed out that these are the audit procedures you have carried out in your auditor's report, then please show me the audit evidence or audit works you have performed within the course of audit, which is in line with the requirement of audit procedures you yourself stated in the auditor's report. Your auditor documentation has to be exactly in the same order, same fashion, in line with in the response to the CAM what you have stated in the auditor's report. If you have not done, then there is a huge risk you are carrying with yourself. So whenever you declare something or put it something as CAM, under CAM, please ensure yourself, is there any requirement of putting this as CAM? If yes, make sure that whatever you are doing to assure or giving a reasonable assurance that all are true and fair, all the audit points, exactly what you are doing, put it in that response to the CAM. Don't put any fancy audit procedures which you are actually not following. Since the second question was related to CAG queries, all the CAG corporations, listed companies, I'll put it in CAG nowadays, they have started issuing POMs on CAMs, because we are habituated of copy pasting and following what the other company has done. What the auditor, in one of the instances where I am advising the client, what it has happened, the auditors have listed out 6 scams, say, in the previous year 2021. Now the new auditors have joined in. They said that these 6 scams are not appropriate for this company, and this company is typically a joint company, joint auditors company. There are 3 auditors, so 2 are old, 1 is new. So new auditors talks and discusses with the other auditors that the 6 scams given for the financial year 2021 are not appropriate, not required. Out of 6, 3 are appropriate, 3 are not. Please remove it. So they have removed it. CAG has issued the POM. What is the ground on which you have issued the POM, this CAMs? So as it is easy to put CAMs, it is not that easy to remove the CAMs which you have already disclosed or reported in the previous years, because you're in a continuous audit practice, your CAMs over the period does not change. There could be a situation that CAMs reported in previous year may not be the same in current year. Yes, there could be situations, but in case if you are adding a new CAM or removing an old CAM in the current year reporting, please ensure what is the trigger point for removal or addition of that CAM. The trigger point has to be substantiated and justified. If there is no trigger point, either in removal or in addition of CAM, then please avoid that situation, continue the same CAM. But in case if you may be right that those 6 CAMs are not appropriate, but wrongly somewhere it is existing, put out such a documentation which justifies the trigger point of removal of inappropriate CAMs. But please, please, please give some quality time in justifying whether CAM is applicable. If yes, what are those CAMs to be reported? And please don't copy paste as it is the responses which are publicly available with similar CAMs, because with similar CAMs, the audit procedures are of that auditor. It may not be of yours. So responses actually to be of yours. You visualize to that particular item what audit procedures you are following and what improvements can be done. What exact work you are doing, please translate it as audit procedures as a response to the CAM in the auditor's report. Please, again with folded hands, please avoid putting responses as copy pasted with similar CAMs given in similar comparable companies. Your response to the CAM has to be yours based on actual work you are doing with, in particular, that audit engagement. So don't copy paste in CAM. Now, what are the factors to consider that how you arrive in a company that this has to be CAM, and all these items has to be evaluated. First, nature and extent of communication about the matter with TCWG. Suppose, for example, in a company, I am saying inventory is the CAM, potential CAM. I need to report in auditors report. But during the course of audit, starting from acceptance, there is no document or communication with the management wherein you brought to the notice of the management that there is an issue with the inventory. I have not issued a single letter or made a single communication related to inventory, be it physical verification, be it valuation, be it whatever related to inventory with the management. But I am insisting on the CAM. No, there has to be nature and extent of communication. If there is a sufficient communication available on a particular item with the management, then that triggers a point that this could be a potential CAM. Second parameter, importance of the matter to users, understanding of FS. Understanding of FS, this is critical. If you feel this particular transaction or element in the FS is significant, as far as not in terms of numbers, it is significant in terms of understanding of the FS. For example, there is actuarial valuations done, employee liability is provided. If you feel that employee liability may be voluminous, but as far as user is concerned, for him it is not that material, then even though it is substance over form, it is material, it may not be a CAM issue. But if you feel the employee liabilities, there are employee unions, there are litigations, and even though the amount is small, but it has a bearing of understanding the financial statement, you can go ahead and put it as part of your CAM. Third, nature of underlying accounting policies, its complexity and subjectivity. Every financial statements are reflection of its accounting policies through numbers, because accounting policies are like theories or the storylines, and it is the cinematic representation of those accounting policies through numbers are your financial statements. So if any accounting policy is complex and lot of subjectivities are involved related to estimation or measurement of a particular financial statement line item, then you can think of a potential CAM therein. Fourth, nature and materiality of corrected and accumulated uncorrected misstatements due to fraud error related to the matter. That could be a possible CAM. Here I bifurcate accounting standard clients and Ind-AS clients, because the mannerism you deal with fraud and error in Ind-AS and non-Ind-AS are little different. So you can put it this way. Nature and extent of audit efforts needed to address the matter. Suppose there are a particular transaction which requires substantial amount of quality time of the audit team is concerned, and so in that you can think of putting that in CAM. Then a nature and severity of difficulties faced by the auditor in applying audit procedures, evaluating results of those procedures and obtaining relevant and reliable audit evidences. I'll put this in context of revised schedule 3. I don't know how many of you have already started implementation of revised schedule 3 or already started with private companies or any companies. This edging of trade payables, because in India we always, as far as the receivables are concerned, there are edgings available, though it was not that vertically and horizontally expanded, but we used to have receivables edging 6 months and above 6 months. But unless there is a good corporate governance company where management reporting was so strong, trade payables are edging as a Herculean task to get it. The kind of reporting requirement right now is there in revised schedule 3. If you find it difficulty in justifying the edgings of what the management has done, that could be a potential area you can put it in CAM. Similarly, in case of CBIP classification, CBIP aging, CBIP cost and time overrun cases, if you find a difficulty in justifying audit procedures that it required, then that could be a potential area this time in the FY 21-22, put it in CAM. Then severity of any control deficiency identified relevant to the matter. And last, whether matter involved number of separate but related audit considerations. So these, under these parameters, you evaluate each transaction of your FS line item. And if you feel yes, there is a potential CAM to be reported, please go ahead and report to that CAM. And when you put the responses to that CAM, because your CAM reporting is complete only when you put your auditing responses to that particular CAM. I have identified this CAM, and these are the audit procedures I have considered myself and worked out as a response to mitigate those inherent risks, so as to opine on the financial statement that it is true and fair, and give the reasonable assurance to the stakeholders. So please make sure that the audit responses, whatever you are listing it against those identified CAMs, it has to be your own, not borrowed from any similar comparable company. So please put it as exactly what you are intending to do with that particular client. Then description of the CAM. There are three things which you should consider in description of the CAM, and all the CAMs has to be a matter of professional judgment, because there is no quantifiable parameters like in modified opinions. We said through that simple table, if this is getting ticked, you issue qualified opinion. If that is getting ticked, you issue adverse opinion. If something else is getting ticked, you issue a disclaimer of opinion. But in CAM, there is no such a tabular format logic you can inbuilt in our audit system. It has to be purely on professional judgment, varies case to case. So description of each CAM should cover following three aspects: reference to the related disclosures. Again, CAM is something which has a reference to the financial statement. You cannot put something under CAM which is not getting reflected in the financial statement. It has to be there as part of financial statement. Second is why matter was considered to be one of the most significant in audit and therefore determined as CAM. The reasoning of CAM determination has to be put it in our auditor's report. How the matter was addressed in the audit. This is the response you have given through your audit process. So these three elements has to be given as part of description of each CAM. In description how the matter was addressed, auditor may cover following aspects: auditor's response and approach to the addressed matter, a brief overview of the audit procedures performed if it is not ticked wise, an indication of the outcome of the auditor's procedures, and auditor's key observations with respect to audit matters. Now, again, I am going to draw your attention to what we have discussed in SS 700, 705, and 706. CAM is not a replacement of your modified opinions. As straight as it is. Again, CAM is not a replacement of your modified audit opinions. CAM is independent of your modified opinions and UMs and CARO. These are the cases where CAM section is required, but no CAM will be communicated. This is few normally technically we go wrong. So please, these are the only three situations where CAM sections will appear, but you need to spell out that no CAM will be reported. In listed company, auditors determines there is no CAM because reporting of CAM is mandatory. Suppose I am doing the audit of a listed company, I have not mentioned any CAM, then technically I have gone wrong. So in a listed company, I need to put that there is no CAM identified during the process of audit in the CAM section. I cannot keep it blank. I need to put it specifically that no CAMs got identified. Then auditor determines that CAM should not be communicated due to restriction in para 14 of SSN or no other CAM determined by him. What is this restriction under para 14? Restriction of para 14 and 15 of SS 700 says that if this leads to modification of opinion, then CAM reporting is not required, because you are concluding that in your modified opinion. Third, the only CAM determine is a matter giving rise to modified opinion or a material uncertainty in conjunction with the second line. So if in the process of identification of CAM and giving response to the CAM, if that triggers to modification of opinion, then immediately you should not give CAM, rather you issue a modified opinion. So this is related to CAM, and this slide, please keep a note of this, because many a times we don't appreciate the interrelationship of CAM with other elements of the auditor report, and we end up reporting technically wrong. So CAM versus auditors modified opinion, CAM versus COMs, CAM versus going concern. CAMs are independent of going concern, EOM and modified opinion. In case there is a situation of issuing modified opinion, then CAMs will not be issued. In case EOMs are given, CAM is separate. In case of going concern, again, it cannot be clubbed with CAM. Going concern has to be reported separately, under SA 570. So this is related to all CAM and auditors reporting deliverable. To sum up, what are the new things which you need to keep in mind this time? CARO 2020 is purely a binary questionnaire where you need to say yes or no. If your answer to the question is yes, you need to report something. If your answer is no, you need to report something. Your CARO reporting is not a substitute of your SA 701, 705 and 706. CARO reporting is not a substitute of your modified opinions wherever it is applicable. And CARO answering is not a qualified opinion. Sometimes, always we assume, in case we are putting some qualifications CARO, it is a qualification. No, in CARO, it is not a qualification. In CARO, we are just replying to a set of questions first. Second, take cognizance of Rule 11 as amended in 2021. All those out of 6, 1 is deferred, rest 5 has to be reported under other regulatory matters under paragraph. Please take cognizance of that. Be watchful on Rule E and F, and take the help of implementation guide. And the implementation guide is beautifully drafted. Keep the wordings as it is, as given in the implementation guide. Don't confuse yourself with EOMs and audit modified opinions. EOMs are independent of audit opinions, and so please have a distinction of these two and give the issue of these two. Then please take cognizance of your revised Schedule 3 disclosure requirements, and there could be a different potential camps which might arise due to this revised Schedule 3 implications. So these are the new things which you need to keep in auditor's report this time. And this is from my side. We can take up if questions are there.
Yes, sir. Thank you so much for your time, sir. So let me just check if there is any question. Many were requesting for the presentation material, sir, and if you permit, we can share the PDF material.
Yes, you can share the presentation material.
Okay, so I will convert this as a PDF and will share it with the registered audience along with the recordings of the session, so it will be easy for them to review, and we'll be uploading the same in YouTube channel. So and as of now, apart from those 3 questions, can't see any questions as of now. We just check. We'll check with the audience also. If they can unmute, they can unmute and ask the question. So 1 minute, sir. We'll give 1 more minute time, or else then we'll wind up.
Sure.
question, sir. It came up now. You just check whether.
Yes. This question, and during our discussion, I have already addressed it because this is a new point in standalone they are asking about. So in the practice, if you see the listed companies reporting whatever is being done during the year for 21-22, there are few companies, those who have gone ahead saying that this will be reported in CARO. In CFS, because in CFS CARO is not applicable. So they have said in the SFS CARO that it will be reported in CFS auditors report. But there are few listed companies wherein the auditors thought that since it is part of CARO and CARO is a part of law, CARO order is part of law, they have reported this element in SFS also. So there is some clarity is required in guidance note. Maybe in the revised guidance note they will issue certain clarity. But either way, it is fine because in SFS, reporting of CFS numbers are doesn't make any sense. So many companies, they have done this, they have referred it, and they have said it. The reporting will be done in the CFS auditors report. Sir, if CAM is given in 1 year of the private company in earlier year, do you need to continue in the subsequent years? See, for private companies, it is optional. And it is not necessary that CAM has to be, same CAM has to be given every year, because CAM is specific to the audit engagement. And every year, even though you are doing the audit of same client, it is different audit engagements. So last year, suppose in the audit engagement, I found out that that particular item was significant and I have issued a CAM. And this year, that item is not significant. It is not necessary to continue that CAM. Technically, there is no harm in discontinuing the CAM, but as part of good quality audit documentation, please make sure that if you are withdrawing a CAM, please ensure that your document should state that what is the trigger point of withdrawing that CAM, and you can withdraw it. So there is no necessity that we should compulsorily need to continue the CAM reporting in case of a private company. Is giving EOM requires us to comment true and fair of the financial statement? No. EOM is, see, true and fair, forming opinion on true and fairness of the financial statement is through our forming of opinion. But if you are putting something under emphasis of matter clearly says it is nothing to do with of my forming of opinion. I am not forming any opinion by putting EOM. So EOM, just I'm drawing attention to a particular transaction or disclosure in the financial statement just by giving a reference for a better understanding and reading of the user of the financial statement. So EOM in no case is a comment on true and fair statement, fairness of the financial statement. It is not, I'm not forming an opinion on the financial statement.
You see, any other questions?
Yeah. In any case, if you find any questions from the audience side, please do let me know, and audiences, please note down my number. You can contact me anytime.
Yes, sir.
And please circulate the presentation.
Yes, sir. We'll be sharing it the same in 1 or 2 days time, along with the recordings once it is done. We'll be uploading in our YouTube channel also, in SIRC YouTube channel, so it will be visible to public. So as
Thank you
now,
so much.
there's most questions, sir, and our treasurer sir is engaged with another meeting, so he couldn't join back again for vote of thanks. So we take a privilege in proposing vote of thanks, sir, on behalf of SIRC, chairman, secretary, and the treasurer and the office bearers in the absence, sir. We thank you so much for the time spent here, sir.
Thank you so much.
Have you so in person in Chennai for physical session too, sir, in future. And thank you so much for the time, sir. Thank you.
Thank you so much.